For the last 82 years, building wealth has followed a very simple rule. Buy stocks in the United States and hold them for the long term. That strategy worked for generations because the United States sat at the center of the global financial system. But today, that system is quietly starting to change. Gold prices are rising faster than many stock markets. Investors are beginning to move their money outside the United States, and more countries are slowly trying to reduce their reliance on the US dollar. And this shift matters more than most people realize. Because the people who understand what is happening early will be able to position their money and grow their wealth faster, while the people who ignore these changes may slowly fall behind. You can already see the early signs of this problem today. A large percentage of Americans don't have enough money saved to retire comfortably, because traditional investment accounts are not growing fast enough, while the cost of living continues to rise. So to understand where things might be heading, we need to go back 82 years to 1944, when the US dollar officially became the world's reserve currency. Being the world's reserve currency comes with three very powerful advantages. First, countries around the world trade major commodities like oil using the US dollar. Second, investors and governments across the globe store their wealth in dollars when they want safety and stability. And third, this global trust gives the US dollar enormous value, even though it isn't backed by physical gold. In reality, the dollar is simply paper. It costs only a few cents to print a $100 bill. But the reason that piece of paper holds value is because the entire world believes in it. Countries trade with it, investors save with it, and financial systems depend on it. Because of this trust, the United States has something that economists often call an exorbitant privilege. It means the United States can borrow and print money in ways that most other countries simply cannot. That's a big reason why the US government has accumulated more than $38 trillion in national debt. The government collects taxes, spends that money, and when it wants to spend more than it collects, it borrows the difference. That borrowing can come from everyday investors, banks, foreign governments like Japan or China, or from the central bank itself, the Federal Reserve. The Federal Reserve has a unique power. It can create new money. When money is created and injected into the system, it allows the government to keep spending and keep the economy moving. But there's a cost to this system, and that cost is inflation, the rising prices of everyday goods and services. In fact, today, one of the largest expenses for the US government is not the military, but the interest payments on all of that national debt. Still, for decades, this system worked because the world continued trusting the dollar. Foreign investors kept buying US stocks, US bonds, and US real estate. That constant flow of global money helped push American asset prices higher and allow generations of investors to build wealth simply by investing in the US stock market. For many decades, you could put your money into something like the S&P 500, leave it there for years, and expect that growth to help you retire comfortably. But now, more than 8 decades later, some cracks are beginning to appear. One of the biggest signals of this shift can be seen in gold. Gold prices have been breaking record highs year after year, and that tells us something important about investor psychology. Unlike a business, gold does not produce income. It has no employees, it doesn't create products, and it doesn't generate profits. When you buy gold, it simply sits there. In contrast, when you buy shares of a company, you're investing in innovation, productivity, and economic growth. So when investors begin rushing into gold, it usually means they're worried about something. They're concerned about inflation, about currencies losing value, or about instability in the financial system. Gold becomes a way to protect wealth when confidence in traditional systems starts to weaken. And today, the biggest buyers of gold are not individual investors, but central banks around the world. Many countries are quietly accumulating gold reserves to strengthen their currencies and reduce dependence on the US dollar. At the same time, global investors are also starting to diversify away from the United States. Just a few years ago, the majority of global investment money flowed into US stocks. In 2022, about $92 out of every $100 invested globally went into American markets. But by 2026, that number dropped dramatically, with far less money flowing into the United States and more capital moving into markets across Asia and Europe. Part of the reason is that the dollar has weakened in recent years, and part of it is that US stocks have become extremely expensive compared to other regions. A large portion of the American stock market is now dominated by just a handful of massive technology companies, which means the entire market is becoming more concentrated. Meanwhile, many economies around the world are growing faster, creating new opportunities for investors who are willing to look outside the United States. Another major trend is that countries themselves are beginning to rely less on the dollar for international trade and reserves. In the early 2000s, roughly three-quarters of global currency reserves were held in US dollars. Today, that share has dropped significantly as countries diversify into other currencies and assets. Alliances like the BRICS Group, which includes Brazil, Russia, India, China, and South Africa, have been exploring ways to trade with each other using their own currencies rather than the dollar. Even in global oil markets, which have traditionally been dominated by dollar transactions, some countries are experimenting with alternatives. This matters because the dollar's strength ultimately depends on global confidence. The less the world depends on it, the weaker that system could become over time. Now, none of this means the United States will suddenly lose its economic power. The US remains the largest economy in the world and one of the most important financial markets on the planet. But what is changing is that the US may no longer be the only major opportunity for investors. As new economies rise and global financial systems evolve, more investment opportunities are appearing across different regions and industries. For investors, that creates both risk and opportunity. Some people hedge their bets against a weaker dollar by holding assets like gold. Others diversify internationally by investing in companies and markets outside their home country. There are even funds and investment vehicles designed to give investors exposure to entire regions or emerging economies that could grow faster in the future. Of course, every investment carries risk. Markets rise and fall, and no strategy guarantees profits. That's why understanding economic trends and doing your own research is critical before making financial decisions. But the key lesson here is simple. The global financial system is slowly evolving. The forces that shaped wealth building for the past 80 years may not look exactly the same in the next 20 or 30 years. The investors who pay attention to these shifts and adapt their strategies will likely have a major advantage. Because in a changing world, the biggest opportunities often appear before most people even realize that the system itself is changing.